You place the trade. Your analysis is perfect. Everything lines up. But the moment you click that buy button, something shifts inside you. Your heart races. You refresh the chart every 30 seconds. You can't sleep. You can't focus on anything else. And then, almost inevitably, you exit too early or hold too long, and what should have been a winning trade becomes another lesson in emotional management. Sound familiar? What if I told you that the secret to consistent trading profits has nothing to do with better indicators or smarter strategies, but everything to do with mastering a principle that ancient philosophers understood thousands of years ago? Trading is psychological warfare, and most traders are losing the battle not because they lack knowledge, but because they're attached to outcomes in ways that destroy their decision-making ability. The market doesn't care about your mortgage payment. It doesn't care that you need this trade to work out. It moves according to the collective actions of millions of participants, each with their own agenda, their own fears, their own desperation. And when you're desperately attached to a specific outcome, you've already lost before the market even opens. The law of detachment isn't some mystical concept reserved for monks meditating in mountain temples. It's a practical psychological principle that elite traders use every single day to maintain the emotional equilibrium necessary for long-term success. This principle states that you must release your attachment to specific outcomes while remaining committed to your process. You focus on what you can control, your research, your risk management, your entry and exit rules, and you completely let go of what you cannot control, whether the market moves in your favor or not. Think about the best traders you've ever heard of: Paul Tudor Jones, Ray Dalio, Linda Raschke. What separates them from the millions of retail traders who blow up their accounts? It's not that they have access to secret information or magical indicators. They've mastered the ability to execute their strategy without emotional interference. They've internalized that each individual trade is just one data point in a massive sample size. They're completely detached from whether this specific trade wins or loses because they trust their edge over thousands of trades. When you're emotionally attached to a trade, your brain shifts into survival mode. The amygdala, the primitive part of your brain responsible for fear responses, takes over from your prefrontal cortex, the rational decision-making center. This is why you make your worst trading decisions when money is on the line. You're literally not thinking with the same part of your brain that created your trading plan. You planned the trade when you were calm and rational. You're executing it while your primitive brain is screaming about threats to your survival. Money represents security, status, freedom. When you attach your self-worth or your immediate financial needs to individual trades, you create a psychological pressure cooker. Every tick against you feels like a personal attack. Every dollar lost feels like a piece of your identity being stripped away. This is the opposite of detachment, and it's the fastest way to destroy a trading account. The law of detachment requires you to completely separate your sense of self from your trading results. You are not your profit and loss statement. You are not your win rate. You are not your account balance. You are someone who trades as part of a broader life strategy, and any individual trade is completely irrelevant to your identity as a person. This sounds simple, but it requires deep psychological work that most traders never do because they're too busy searching for the next hot indicator or trading signal. Detachment doesn't mean you don't care. This is where people misunderstand the concept. A detached trader cares deeply about their process, their risk management, their continuous improvement. What they don't care about is whether this specific trade, right now, works out. They've done their analysis. They've sized their position appropriately. They've set their stop loss and take profit levels. Now they wait. If the trade hits their profit target, excellent. If it hits their stop loss, equally excellent, because they've just received data about their strategy. Consider a casino. The casino is completely detached from whether you win any individual hand of blackjack. They might even celebrate with you when you hit a big win. Why? Because they understand probability over large sample sizes. They know their edge. They know that over thousands and thousands of hands, the mathematics works in their favor. Individual outcomes are completely irrelevant. They focus on keeping you playing so their edge can express itself over time. As a trader, you need to think like the casino, not like the gambler. Most traders trade like gamblers because they need the next trade to win. They're trading with scared money, either because they can't afford to lose it or because previous losses have created emotional damage that hasn't healed. Scared money always loses because fear makes you irrational. You cut winners short because you're terrified of giving back profits. You let losers run because you can't accept being wrong. You revenge trade after losses because your ego demands you prove you're right. All of this stems from attachment. Detachment begins before you ever place a trade. It starts with proper capitalization. If you're trading with money you can't afford to lose, you will never achieve detachment. Period. The psychological pressure is too intense. You need to be trading with capital that, if it disappeared tomorrow, would not fundamentally alter your life. This doesn't mean you should be reckless. It means the capital needs to be genuinely risk capital, money allocated to speculation with the full understanding it could be lost. Position sizing is another critical element of detachment. If you're risking 5 or 10% of your account on a single trade, you're making detachment impossible. Your nervous system cannot remain calm when that much of your capital is at risk. Professional traders typically risk between 0.5% and 2% per trade. This ensures that even a string of losses doesn't create emotional distress that compromises future decision-making. When your position size is appropriate, you can watch the market move against you without triggering your fight or flight response. The practice of detachment also requires you to stop watching every tick. This is counterintuitive for most traders. They think they need to monitor their positions constantly to make good decisions. But the opposite is true. Constant monitoring increases attachment. Every small move against you triggers an emotional response. You start second-guessing your analysis. You start imagining all the ways the trade could go wrong. Your rational brain goes offline and your reactive brain takes over. Set your trade up properly, place your orders, and then step away. Check your positions once or twice a day maximum unless you're day trading. And even if you are day trading, you should be following a predetermined plan that doesn't require constant emotional decision-making. The more you can automate your entry and exit criteria, the more you separate your emotions from the process, the better your results will be. Detachment means accepting that uncertainty is fundamental to trading. You will never have perfect information. You will never know for sure what the market will do next. No one does. The market is a complex adaptive system influenced by countless variables, most of which you can't even perceive, let alone analyze. When you accept this uncertainty at a deep level, you stop trying to control it. You stop needing to be right. You start focusing on playing probabilities over time. Think about weather forecasters. They give you a probability. 60% chance of rain. They're not attached to being exactly right because they understand their models have limitations. They're giving you their best assessment based on available data, but they know the system is too complex for certainty. Traders need the same mindset. Your analysis gives you a probability, not a certainty. Detachment means accepting that your 60% win rate strategy will lose 40% of the time and being completely okay with that. The emotional freedom that comes from detachment is profound. When you're not desperately attached to outcomes, trading becomes almost relaxing. You've done your work. You've placed your bet based on sound analysis and proper risk management. Now you wait to see what happens, genuinely curious about the outcome, but not emotionally invested in it. This state of mind is where your best trading happens because your rational brain stays online. Detachment also protects you from one of the biggest destroyers of trading accounts, revenge trading. When you take a loss and you're attached to that outcome, your ego gets bruised. You feel like the market has personally wronged you. Your brain demands immediate justice. You want to get that money back right now. So you jump into another trade without proper analysis, usually with a bigger position size, and you compound your loss. This cycle has destroyed countless traders who had perfectly good strategies but couldn't manage their emotional responses to losses. A detached trader sees a loss and feels nothing more than mild curiosity. The trade didn't work out. Why not? Was it bad luck within the normal variance of their strategy? Or was there something about the setup they missed? They analyze the trade dispassionately, extract whatever lesson is available, update their journal, and move on. There's no emotional charge, no need for revenge, no urgent compulsion to make the next trade immediately. Journaling is essential for developing detachment. When you write down your trades, including your thought process, your emotional state, and the outcome, you create psychological distance from the heat of the moment. You start seeing patterns in your behavior. You notice that you take your best trades when you're calm, and your worst trades when you're emotional. This awareness itself begins to shift your behavior because no one wants to keep doing things they know don't work. Your journal should track not just what you did, but how you felt before, during, and after each trade. Over time, you'll see correlations between your emotional state and your results. This data gives you the power to intervene in your own psychological patterns. When you notice you're feeling desperate or angry or overconfident, you can recognize that as a signal to step away from the keyboard rather than place a trade. Meditation and mindfulness practices dramatically accelerate the development of detachment. When you practice observing your thoughts without identifying with them, you build the same muscle you need for trading. You learn to notice fear arising without acting on it. You learn to notice greed arising without acting on it. You create space between stimulus and response, and in that space lies your power to choose your actions consciously rather than reactively. Even just 5 or 10 minutes a day of sitting quietly and observing your breath can transform your trading. You don't need to become a meditation master. You just need to practice the basic skill of noticing your mental and emotional patterns without being controlled by them. This is the essence of detachment, awareness without identification. The law of detachment also applies to your overall trading performance. You cannot be attached to having a profitable month or quarter. Markets go through different cycles. Sometimes your strategy will work beautifully. Sometimes market conditions will shift, and your edge will temporarily disappear. A detached trader stays committed to their process through drawdowns, trusting that their edge will reassert itself when market conditions align with their strategy again. This requires enormous patience. In our culture, we're conditioned to expect constant progress and immediate results. But trading doesn't work that way. You might have 3 losing months followed by 2 incredibly profitable months. If you abandon your strategy during the drawdown because you're attached to consistent monthly profits, you'll miss the winners that make your entire year. Detachment gives you the patience to stick with sound strategies through inevitable rough patches. Professional traders often talk about trading being boring when you're doing it right. This boredom is actually a sign of proper detachment. When trading becomes an emotional roller coaster, you're too attached. When it's just another day at the office, executing your plan without drama, you've achieved the psychological state necessary for long-term success. The excitement should come from the process of continuous improvement, not from the thrill of each individual trade. Understanding that you're playing an infinite game rather than a finite game is crucial for detachment. You're not trying to win trading. There is no final victory condition. You're simply trying to express an edge over time, continuously adapting as markets evolve, always learning, always improving. This perspective shift eliminates the desperate need for any particular outcome because you know you'll have thousands more opportunities. Your identity should be as someone who executes a proven process, not as someone who makes winning trades. This subtle distinction has massive psychological implications. If your identity is tied to winning, every loss threatens your sense of self. If your identity is tied to process execution, then a loss that followed your rules is actually a win because you did what you were supposed to do. The market just didn't cooperate this time, and that's fine. Detachment requires you to kill your ego at the door before you start trading. Your ego wants to be right. It wants to prove how smart you are. It wants to impress others with your brilliant market calls. But the market doesn't care about your ego. In fact, your ego is your biggest enemy in trading. It makes you stubborn about losing positions. It makes you talk about your winners and hide your losers. It makes you take trades to prove a point rather than because they meet your criteria. The traders who last decades in this business are the ones who genuinely don't care what anyone thinks about their trading. They're not posting their winners on social media. They're not arguing about market direction on forums. They're quietly executing their process, taking their lumps when they're wrong, banking their profits when they're right, and constantly refining their approach. This ego death is hard, but it's essential for true detachment. One practical technique for building detachment is to think about trades in terms of risk units rather than dollars. Instead of saying you made or lost $500, you made or lost one risk unit, or R. This psychological reframing helps you focus on the process rather than the emotional impact of the money. Over time, you start thinking in terms of your risk-reward ratios and your expectancy per risk unit, which are the metrics that actually matter for long-term success. Detachment also means being willing to miss trades. This is harder than it sounds. When you see a setup developing, but it doesn't quite meet all your criteria, the fear of missing out can be overwhelming. An attached trader will talk themselves into the trade with rationalization after rationalization. A detached trader will watch the market move without them, completely at peace with missing an opportunity, because they know other opportunities will come. They trust their process more than they fear missing out. The ultimate test of detachment is how you handle your biggest wins and your biggest losses. Can you take a massive profit without becoming overconfident and reckless in your next trades? Can you take a massive loss without becoming fearful and hesitant? If you can maintain the same calm, methodical approach, regardless of recent results, you've achieved real detachment. Your emotions flow through you without controlling your actions. This doesn't happen overnight. Detachment is a practice, not a destination. You'll have moments where you slip back into attachment. You'll take a loss personally. You'll get too excited about a winner. The key is to notice these moments quickly, forgive yourself, and return to your practice. Over months and years, the periods of genuine detachment get longer and the slips get shorter. Think of detachment as building a psychological immune system for trading. Just as your body's immune system protects you from physical threats, psychological detachment protects you from emotional threats that can destroy your trading account. Every time you practice detachment, you strengthen this immune system. Every time you notice an emotional reaction and choose not to act on it, you're training yourself to be a better trader. The law of detachment ultimately gives you the freedom to succeed in trading because it removes the primary obstacle to success, yourself. Your worst enemy in trading is not the market, not other traders, not lack of capital or tools or education. It's your own mind, your fears, your greed, your need to be right, your attachment to specific outcomes. When you remove that enemy through detachment, trading becomes a game of probabilities that you can play skillfully over the long term. This is where consistent profitability lives, in the calm, detached execution of a proven process, trade after trade after trade, regardless of individual outcomes.